A war doesn't just destroy economies, it reshapes them, and the smartest investors know exactly how to profit from that shift. The idea that the U.S. Iran conflict could make smart investors rich is not about profiting from war itself, but about how geopolitical shocks influence financial markets and create opportunities for disciplined, long-term investors. Conflicts of this scale tend to disrupt energy markets, increase uncertainty, and shift capital flows across asset classes. While headlines may focus on fear and volatility, experienced investors often look for mispricing, sector rotation, and macroeconomic trends that emerge in such environments. To understand the full picture, it's important to examine how markets typically behave during geopolitical conflicts, what sectors tend to benefit, what risks are involved, and why timing and strategy matter far more than simply reacting to events. At the core of the argument is the relationship between geopolitical instability and market behavior. Financial markets are forward-looking, meaning that prices constantly adjust based on expectations about the future. When a major conflict like the U.S.-Iran situation escalates, uncertainty rises sharply. Investors often react by selling risk assets, such as equities, which can lead to sharp declines in stock prices. This initial reaction is driven by fear of potential outcomes such as military escalation, economic disruption, or global instability. However, this reaction can sometimes be exaggerated, leading to temporary overcorrections where asset prices fall below their intrinsic value. This is where smart investors look for opportunities to buy fundamentally strong assets at discounted prices. One of the most immediate and visible effects of the U.S.-Iran conflict is its impact on energy markets, particularly oil. Iran is a key player in the Middle East, and tensions in the region can threaten the flow of oil through critical choke points such as the Strait of Hormuz. This narrow waterway is one of the most important oil transit routes in the world, and any disruption can lead to a spike in global oil prices. When oil supply is threatened, prices tend to rise due to concerns about scarcity. Higher oil prices can benefit energy-producing companies, especially those with strong reserves and efficient production capabilities. However, rising oil prices also contribute to broader inflationary pressures in the global economy. When energy becomes more expensive, the cost of transportation, manufacturing, and goods increases across the board. This can reduce consumer purchasing power and slow down economic growth. Central banks may respond by raising interest rates or maintaining tighter monetary policies to control inflation. Higher interest rates can negatively affect stock valuations because they increase the discount rate used to calculate the present value of future earnings. As a result, growth-oriented sectors, particularly technology stocks, may experience downward pressure in such environments. Despite these challenges, certain sectors historically perform well during times of geopolitical tension. Defense and aerospace companies often benefit from increased government spending on military operations and equipment. When governments prioritize national security, defense budgets tend to rise, leading to higher revenues for companies involved in weapons manufacturing, cybersecurity, and military logistics. Similarly, energy companies, especially those involved in oil and gas exploration and production, can see increased demand and higher profit margins due to rising commodity prices. These sectors are often viewed as war beneficiaries, not because of the conflict itself, but because of the economic conditions it creates. Another important concept is the role of safe haven assets. During periods of uncertainty, investors often move capital into assets perceived as more stable and less risky. Gold is one of the most well-known safe haven assets, as it tends to retain value during times of geopolitical turmoil and inflation. Government bonds, particularly those issued by economically stable countries, also attract investors seeking security and predictable returns. It is also important to consider how market sentiment evolves over time during a conflict. In the initial phase, fear and uncertainty dominate, often leading to sharp declines in equities and increased volatility across markets. This is sometimes referred to as the shock phase. As more information becomes available, markets begin to reassess the situation and estimate the actual economic impact. This leads to the repricing phase, where asset prices adjust based on updated expectations. Finally, in the rotation phase, investors shift their capital into sectors and assets that are expected to perform well under the new conditions. Smart investors aim to identify these phases and position their portfolios accordingly, rather than reacting emotionally to short-term news. However, it is crucial to recognize that investing during geopolitical conflict is inherently risky. Market conditions can change rapidly, and predictions about outcomes are often uncertain. Conflicts can escalate unexpectedly, draw in additional countries, or lead to prolonged instability. These factors can create prolonged market downturns, rather than quick recoveries. Additionally, liquidity can dry up during periods of extreme volatility, making it difficult to enter or exit positions at desired prices. Even experienced investors can suffer losses if they misjudge timing or underestimate the severity of the situation. Another risk comes from the broader economic impact of conflict. Prolonged instability in the Middle East can disrupt global supply chains, increase transportation costs, and reduce international trade. This can slow economic growth and lead to reduced corporate earnings across multiple sectors. If the conflict leads to sustained inflation and tighter monetary policy, equity markets may face additional pressure. In such scenarios, even sectors that initially benefited from the conflict may eventually experience declines as economic conditions worsen. Diversification also plays a key role in managing risk during uncertain times. Rather than concentrating investments in a single sector or asset class, smart investors spread their capital across different industries and geographies. This helps reduce the impact of any single event on the overall portfolio. For example, holding a mix of energy stocks, defensive sectors such as healthcare and consumer staples, and safe haven assets like gold can provide balance during periods of volatility. Diversification does not eliminate risk, but it helps manage it more effectively. Another important strategy is hedging, which involves using financial instruments to offset potential losses. For example, investors may use options, futures, or inverse exchange-traded funds to protect their portfolios against downside risk. While these tools can be complex, they are often used by institutional investors to manage exposure during uncertain times. Hedging can be particularly useful in geopolitical crises, where market movements are difficult to predict. It is also essential to distinguish between short-term trading and long-term investing. Some traders attempt to profit from rapid price movements caused by news events, but this approach requires a high level of skill, experience, and risk tolerance. In contrast, long-term investors focus on the underlying value of assets and aim to hold investments over extended periods. During geopolitical conflicts, long-term investors are generally better positioned to benefit from market recoveries, as they are less affected by short-term volatility. Ethical considerations also play a role in how investors approach this topic. While financial markets may present opportunities during times of conflict, it is important to recognize the human cost of war. Conflicts lead to loss of life, displacement, and economic hardship for millions of people. Many investors and institutions consider these factors when making decisions, and some choose to avoid investments that directly benefit from warfare. Responsible investing involves balancing financial goals with ethical considerations. The idea that the U.S. Iran conflict will make smart investors rich is based on the reality that geopolitical events can create significant market opportunities. However, these opportunities are not guaranteed and come with substantial risks. Smart investing in such environments requires a deep understanding of market dynamics, careful risk management, and a long-term perspective. Rather than attempting to profit from conflict itself, successful investors focus on identifying mispriced assets, managing volatility, and maintaining a disciplined approach to portfolio construction. Ultimately, the key to success lies not in reacting to headlines, but in understanding the underlying forces that drive markets and making informed, rational decisions based on those insights. If you want more insights like this, subscribe now and stay ahead of the market before everyone else catches on.